So picture this. You just paid a massive chunk of income tax. Honestly, your return is filed, everything is done, but your heart still skips a beat when you see an email pop up from the income tax department, right? If you've ever felt that panic, you are definitely not alone. Welcome to today's Explainer. We're going to break down exactly how the modern income tax scrutiny process actually works. We're drawing directly from some incredibly fascinating insights from a former income tax officer to figure out exactly why honest taxpayers still get flagged, and more importantly, how you can protect yourself.
This is hands down the most common fear taxpayers have right now. It doesn't matter if you've paid 10,000 rupees or whopping 30 lakh rupees. Opening your inbox to a message from the tax authorities is just inherently stressful. Well, for the next few minutes, we're going to unpack exactly why these emails get sent out, how modern data analytics are pulling the strings behind the scenes, and how you can navigate this whole system with total confidence.
Okay, here's our roadmap for today's Explainer. 1. The high tax myth. 2. The hidden mismatch traps. 3. The 1961 versus 2025 tax acts. 4. Real taxpayer case studies. And 5. A final compliance checklist. Let's get right into it. Starting with Section 1, the high tax myth. Because we absolutely have to debunk this dangerous assumption right out of the gate. Here's the deal. Writing a massive 50 lakh rupee check to the government, it doesn't magically buy you an invisible shield against scrutiny. And on the flip side, paying a super small amount of tax doesn't automatically make you a high-risk target either. The reality is that scrutiny is triggered by data mismatches. The system is literally just looking for inconsistencies in your reporting. It's not ranking you by the size of the check you wrote. Also, please remember that not every email is a cause for panic. Seriously, a lot of folks immediately assume the worst, but often an email is just a basic intimation, under Section 143(1), or maybe a quick heads up about a refund adjustment. It might even just be a minor defective return notice asking you to fix a typo. An email from the department does not automatically mean the SWAT team is at your door for a full-blown investigation. Moving on to Section 2, the hidden mismatch traps. Let's talk about what actually triggers the AI and those invisible watchers tracking your data. Enter the AIS, the Annual Information Statement. Honestly, this is the beating heart of the modern tax ecosystem. It's a comprehensive statement tracking literally everything: your salary, bank interest, dividends, mutual funds, crypto trades, property transactions, even your foreign assets. Today, the tax department relies heavily on AI and data analytics to constantly cross-check the return you file against your AIS. They are making sure every single penny is accounted for.
And this whole ecosystem is deeply interconnected. You've got Form 26AS, which tracks your tax credits like TDS and advanced tax, but then you also have SFTs, the Statement of Financial Transactions. Banks, property registrars, mutual funds, credit card companies, they are all legally required to report your high-value transactions directly to the government. This data feeds into their system way before you even sit down to file your return. Now, this is a vital takeaway, so listen closely. The automated AI system doesn't judge you. It doesn't look at your file and declare, this person is guilty of tax evasion. Not at all. It's purely a mathematical process. It strictly flags inconsistencies between what third parties reported and what you declared. Once a mismatch pops up, then it gets pushed forward for human review or an automated request for clarification. Hey, real quick, before we decode the massive upcoming shift in tax laws, if you're finding this breakdown valuable and you want to stay ahead of the curve, take a quick second to hit that subscribe button right now. We are absolutely committed to bringing you the most engaging compliance explainers out there. All right, let's get back into it. Section 3, the 1961 versus 2025 Tax Acts. Let's pivot to the monumental shift that has professionals and taxpayers alike kind of sweating right now. We are looking at a total paradigm shift in terminology here. For over 60 years, we've had to juggle the super confusing overlap of previous year and assessment year. Well, the government designed the 2025 Act to eliminate that headache completely. They're replacing it with a simple, unified tax year that aligns perfectly with the financial year. Plus, the new act focuses on simplified language, pulling all those overly complex provisos directly into the main text so ordinary citizens can actually read it. And just look at this massive reduction in complexity. They slashed the total number of legal sections from 819 all the way down to 536. By throwing out obsolete rules and consolidating redundant stuff, they've basically reorganized the entire law to make compliance way easier. The actual tax rates and core policies aren't drastically changing. It's the structure and the ease of compliance that are getting the massive upgrade. But here is the most important thing to remember during this transition. Do not panic. Seriously.
Any pending assessments, notices, or appeals from previous years, those are still going to be handled strictly under the old 1961 rules. The new 2025 Act only takes over for income earned starting April 1, 2026, what we're now going to call tax year 2026-27. It's specifically designed to be a smooth, parallel transition.
All right, Section 4, real taxpayer case studies. We know the rules and we know the AI is watching, so let's look at how this plays out in the real world.
First up, we have Dr. Sharma. Now, he has a solid professional income of 2.8 crore rupees. He filed his returns and paid a massive 34 lakhs in taxes. He naturally thought he was perfectly safe, but he received a mismatch notice. Why? Because he forgot to declare a really small amount of fixed deposit interest. The bank reported it to the SFT, it showed up in his AIS, and boom, the AI flagged the omission. Paying 34 lakhs in tax didn't stop the system from catching a tiny discrepancy.
And it's the exact same story in case number 2. We've got an IT engineer with a salary of 42 lakhs. Their employer deducted their TDS perfectly. It matched Form 26AS flawlessly. However, they omitted the basic, everyday interest generated from their regular savings account. Once again, this tiny little omission was enough to trigger the automated scrutiny system. It just proves that accuracy across all data points is literally the only metric the system cares about. Which brings us to our final section, the compliance checklist. How do we avoid the stressful fate of Dr. Sharma and our IT engineer? Well, if you want total peace of mind, take 10 to 15 minutes before you file to execute these 4 exact steps from our former income tax officer. Step 1, download your AIS and your Form 26AS and compare them side by side. Step 2, manually verify every single line of bank interest and dividends. Step 3, ensure your stock market capital gains and crypto transactions match your broker's reporting exactly. And finally, Step 4, if you have foreign assets, even a tiny overseas brokerage account, you absolutely must disclose it in Schedule FA. Doing this ensures your declared income matches the government's data perfectly. I really want to leave you with this powerful thought from our source material today because it hits the nail on the head. The Income Tax Department is not looking for taxpayers who pay the highest tax. It is looking for returns that do not match the information already available. That quote beautifully summarizes the reality of modern taxation. Accurate, complete, and well-documented compliance is your absolute strongest protection, not fear. So, question for you. Have you logged in and reconciled your AIS today? If you haven't, that should absolutely be your next move. Drop a comment below if you found this explainer helpful, and make sure to hit that subscribe button to join our community. I will see you in our next explainer, where we're going to dive deep into the specific high-value transactions that trigger instant tax department alerts. See you then.